Imagine planting a seed so small, it almost seems useless. But with the right care, that tiny seed grows into a massive tree. That's how compounding works with money. And here's the part most people never tell you. You don't need to start big. You don't need thousands of dollars. You don't need the perfect timing. You just need one thing: to start. But the big question is, what's the absolute minimum amount you need to make compounding actually work? You've probably heard it more times than you can count. You need money to make money. It's one of the biggest financial myths that holds people back from ever getting started. Most people think you need a $10,000 nest egg before you can think about putting money to work. But here's the reality. You don't need to be rich to get rich. You just need to understand how compounding actually works. Say you invest just $5 a day. That's it. Over a year, that's $1,825. That's less than a pack of smokes, less than most people spend on coffee. If you take that $1,825 and invest in a broad market index fund like the S&P 500, here's what happens. After 10 years of investing $5 a day, you've got $29,500. After 20 years, merely $100,000. After 30 years, that small daily habit grows into over $340,000. And in 40 years, you're sitting on over $950,000. You're knocking on the door of $1 million from a $5 a day routine. Is $5 really a lot? Because small amounts, when combined with time and consistency, can grow into life-changing wealth. Think of compounding like a snowball rolling down a snowy hill. At first, it's tiny, but as it rolls, it picks up more snow and grows faster. That's what happens when your money earns returns. Then those returns earn returns, and it keeps going. That's compounding. Most people never roll their snowball. They wait for the perfect moment or a giant chunk of money to magically appear. In reality, they're letting time slip through their fingers, the one thing they can't get back. If you've ever said, "I'll invest once I have more," you're waiting on something that might never come. Every day you wait costs you potential gains. You don't need a lot to get started. You just need to start. When people hear the word investing, many feel overwhelmed. They imagine spreadsheets, stock tickers, and needing thousands to start. But for the average person trying to build wealth slowly, you can start with $1 a day. Yes, a single dollar, less than the cost of a bottle of water. $1 a day means about $30 a month or $365 a year. It may not sound like a lot, but it underestimates the power of compounding. It means building wealth with the bare minimum, whatever you can realistically commit to. If you invest $1 per day into an index fund that averages 10% annually, here's what happens. After 10 years, you've got roughly $6,300. After 20 years, you're sitting on $17,000. And in 40 years, that single daily dollar turns into over $100,000. That's 6 figures from $1 a day. No tricks, no day trading, just time and patience. Now let's say you increase your contributions a little each year, maybe 5 or 10%. Next year, you're putting in $1.10 per day. Within a decade, your dollar a day habit turns into $2.50 a day. And with those increases and compounding, you'll see multiples of what you'd earn otherwise. Because the hardest part of investing isn't knowing where to put your money. It's just putting money in at all. That's why the minimum viable compounding plan works. It removes the pressure and eliminates the "I can't afford it" excuse. You're not trying to max out your retirement account overnight. You're just building a habit. Every great investor started with a small amount. Warren Buffett didn't start with billions. It's about getting started and letting compounding take over. So don't wait until your finances are perfect. Start your minimum viable compounding plan today with whatever you have, even if it's spare change. Let's clear up one of the most dangerous misconceptions. Wealth comes from how long you invest, not how much. Meet person A. They start investing at age 20, putting in just $100 a month. That's $1,200 a year for 10 years, totaling $12,000. Now meet person B. They wait until they're 30 to start investing, putting in $100 a month. They invest until they're 60, totaling $36,000. So who ends up with more money at retirement? You think it's person B, right? After all, they invested 3 times as much. But you'd be wrong. Person A ends up with over $200,000 at age 60, compared to around $180,000 for person B. Because person A gave their money a 10-year head start. That's the secret sauce. Time always beats timing. Most people say, "I'll start investing when I make more." But that logic is broken. They've lost the most valuable asset, time. You can always make more money. You can't make more time. Compounding thrives on time, like fire thrives on oxygen. The first few years, it might not look like much. Your account grows slowly. Give it enough time and suddenly the curve turns upward. It's not linear growth, it's exponential. And those final years, that's when compounding gets aggressive. The question isn't, how much should I invest? It's how early can I start? Even if you can only invest $20 or $50 a month right now, do it. Here's the kicker. By starting young and building the habit, you're more likely to increase your contributions later. It's a double win. If you're in your 20s or 30s, you have the most powerful advantage of all, time. The second best time to start is today. What if I told you there's a simple mental trick that can help you estimate how fast your money will double? Welcome to the Rule of 72. Take the number 72 and divide it by the annual interest rate you expect to earn on your investment. The result? That's roughly how many years it will take for your money to double. Invest your money in an index fund that earns about 10% annually. That's the average return of the S&P 500 over the long term. 72 divided by 10 equals 7.2%. Your money doubles every 7.2 years. Start with $1,000 at age 25. After 7 years, it's $2,000. In 14 years, it's $4,000. In 21 years, it's $8,000. And in 28 years, it's $16,000. By year 35, it becomes over $32,000. That's the compounding curve in action. What if your return was only 6%? 72 divided by 6 gives you 12. Your money would double every 12 years. If you got a supercharged 12% return, your money doubles every 6 years. Want to double your money in 10 years? Then you'd need about a 7.2% return annually. Most people have no idea how powerful doubling is. They think, if I earn 10% this year, that's nice. But they don't realize it's exponential growth. The rule of 72 helps you wrap your head around that exponential growth. The more your money grows, the more dramatic the returns become. By year 35, a $1,000 investment becomes over $32,000. If you add $1,000 each year, you're building a staircase of wealth. The rule of 72 is your secret decoder ring for compound growth. Use it, visualize it, let it motivate you to take action. If you're 40 and starting with $200 a month, you'll have around $237,000 by age 65. Every year counts. Don't miss the big gains. Ever wonder how people who seem normal retire wealthy? It's not luck, it's compounding. Millionaires often don't look rich. They just stayed consistent for a long time. They maxed out their Roth IRAs or contributed to their 401ks. They just let their money grow while they live their lives. Compounding rewards the boring and disciplined. Because quitting kills compounding. Selling during a crash kills compounding. Taking money out early kills compounding. Let's say you're overwhelmed. Investing feels complicated. You don't know where to start. Forget everything else and do this. Invest $10 every week. At 10% annual return, that becomes over $47,000 in 30 years. In 40 years, over $130,000. If you remember nothing else, remember these 3 rules. Start early. Time is your biggest asset. Even small amounts compound like crazy. Be consistent. Automate your investments. Don't skip months. Just keep going. Let it ride. Don't pull out when it gets boring. The longer your money stays in, the harder it works. Here's the real answer. Whatever you can spare today, even if it's $1 or 50 cents, starting is what matters. It's not about waiting for enough money. Stop waiting. Start now. Let compounding do the heavy lifting. And don't forget, if you found this video helpful, like and subscribe for more insights.